Today, we're diving into the dramatic story of a key part of Colombia's economy, and we're doing it with a fantastic guide, a deep dive report from the country's own stock exchange. It's a tale of a massive boom, a spectacular crash, and some really critical lessons learned along the way. So, you ever wonder what really makes a country's economy tick? It's a huge question, right? But often the answer is hiding in these complex systems that quietly move money around. And that idea is right at the heart of our story.
Okay, so let's get into it. Before we can talk about the wild ride of the boom and the bust, we first have to understand the machine that was driving it all. We need to talk about the fixed income market.
And the report itself has this fantastic analogy for it. It calls this market the engine of economic growth. And that's exactly what it is. It's where governments and big companies borrow money by selling bonds, which are basically just IOUs. You can think of it like the plumbing of the economy. It takes money from people who have it saved up, like pension funds, and channels it to where it's needed to build things. We're talking new highways, power plants, you name it. When this engine is running smoothly, the whole country moves forward. And for a few years in Colombia, that engine wasn't just running smoothly, it was absolutely supercharged. This brings us to the first chapter in our story, the boom years. So, picture this, the early 2000s. You've got this perfect storm of positive conditions. Inflation was going down, interest rates were dropping, and the government made a really smart move to start borrowing more money from its own people instead of from other countries. All of this just lit a fire under the market. And check out this number to see just how big that fire was. A 249% increase in the amount of these bonds and other securities out there. I mean, to put it simply, the market size literally more than tripled in less than 10 years. It wasn't just growing, it was exploding. And here's the thing, this wasn't just numbers on a page. People were actually buying and selling like crazy. The amount of trading grew at an average clip of 44% every single year. The market was buzzing with activity. It was dynamic and it was getting a ton of attention. And this wasn't just happening in a bubble. I mean, just look at how they stacked up against their neighbors. Colombia wasn't just keeping pace. It was blowing past major regional players like Mexico and Chile. Its economic engine was roaring louder than almost anyone else's in Latin America. But you know how these stories go. What goes up often comes down. And in 2007, that roaring engine started to sputter, and it led to a really sudden and painful collapse. Wow, I mean, this chart right here tells the whole story, doesn't it? You see that steady climb, then the rocket ship to that incredible peak in 2006, and then the cliff. In just 2 short years, all that activity vanished, collapsing back to where it was before the boom even really got started. Just let that number sink in, a 71% drop. All that activity, all that liquidity, which is really the lifeblood of a market, it just evaporated. The engine had completely seized up. So what happened? Why did the engine just seize like that? Well, the report says it was basically a 1-2 punch. First, the central bank started hiking interest rates to try and cool things down, which made a lot of the existing bonds lose value. And then came the shocker. Regulators suddenly banned a super common way of trading. It was a move that instantly threw a huge wrench in the gears and just froze the market. So now you've got a full-blown crisis. The regulators knew they had to do something, and something bold, to try and get that engine restarted. So they decided to run a major experiment on the entire market. The whole idea was to completely change the rules of how trading was done, hoping it would breathe new life into the system. But the massive question hanging over everyone's heads was this actually going to work? So here's what they came up with. Before the crash, most of the action happened in a public, centralized system, kind of like a stock exchange, where everybody sees the prices. The big fix was to open up something called the over-the-counter, or OTC market. You can think of this as more of a private club, where 2 people negotiate a deal directly. The hope was that this more flexible system would get the ball rolling again. And the verdict? Well, it was not what they were hoping for. The total amount of trading, the #1 sign of a healthy market, it never got back to those crazy highs of the boom years. The big experiment, by that measure at least, was a failure. And this chart, well, this is kind of the smoking gun. It shows us exactly why it didn't work. See, the new OTC market didn't actually create any new business. It just siphoned off trades from the old public system. By 2011, more than 60% of the trading had simply moved over. It was the same amount of water, just flowing through a different set of pipes. Okay, so if the big fix didn't work, what was the real problem? Well, the crash and that failed experiment forced everybody to take a much deeper, much harder look under the hood of Colombia's financial engine. And this is maybe the most important lesson from the entire report. All those good times, all that easy money and crazy growth, had been hiding some really deep, fundamental flaws in the system. The minute the crisis hit, those weaknesses were suddenly out there for everyone to see. The report points to four big issues. First, the government, the biggest player in the game, wasn't very consistent. Second, there wasn't enough diversity. It was basically just the same financial firms trading back and forth with each other. Third, the investors were too passive. They'd just buy bonds and then sit on them, which just kills activity. And finally, the rulebook was old and clunky, and it made it way too hard for private companies to get in on the action. And if you're wondering, so what? Why does this matter? Well, this quote from the report says it all. When the market dries up like that, it just can't do its main job, which is to fund the projects that help the country grow. The engine stalls, and the whole country feels the impact. So it all comes down to this, right? A fast start is great. A powerful engine is awesome, but it's not enough. What an economy really needs is an engine that's built to last, one that's resilient enough to handle the bumps in the road. So what does a resilient engine actually look like? Well, according to this report, it needs a few things. It needs high-quality parts. That means lots of different companies, not just the government, are borrowing. It needs a ton of active participants, both local and foreign, who are always trading. It needs modern infrastructure. And maybe most importantly, it needs a clear, simple, and fair rulebook for everybody. In the end, this whole decade-long story from Colombia shows us that the true test of an economy's strength isn't how fast it grows in the good times, but how well it can weather a storm. And it leaves us with a question, not just for Colombia, but for any country. Are our financial engines built for a sprint, or are they ready for the marathon?